Edutrainment Workshops, the insurance industry's leading education and training platform, presents Life Insurance, the entry-level series, the products, the underwriting, and the planning applications to position your practice as the premier provider of insurance products in your community. Get on board, get on track, get to where you're going. And now, your Edutrainer, national insurance columnist, Steve Savant.
Well, welcome everyone. I'm Steve Savant, your Edutrainer and coach for our Edutrainment workshops and our entry-level courses into the introduction into life insurance. And all this week, we're going to be doing our introduction into participating whole life. I actually cut my teeth on this product, and I think you're going to enjoy this whole week. This is really exciting, and I think I have to say that whole life is kind of making a comeback. But before we get going, I just want to give a little kudos again to our sponsor, Lincoln Benefit Life, an Allstate company, and we're on Lincoln Benefit Life's Eclipse software. All these workshops. If you ever want to say, Steve, I'd like to really understand illustrations, this is the greatest tutorial in my view from an illustration point of view. And if you just hop out to their site at www.lblsales.com/ETW, you'll come to this site, and as soon as you hit this site, just go run installer, download it, and then so when you go back to all our courses that you've had on introduction, I think it's like 65 different 15-minute vignettes. You can go ahead and track with us and go page by page. I think your learning experience and the tutorial will be that much better. Also from Lincoln Benefit Life and Allstate, they have an excellent page here that you can see at the bottom of the screen, as well as it's attached to our search engine optimization page attached to this video, where you can just go copy and paste it into your browser. When you get there, you're going to see a little menu of different items. My first item is called the Facts of Your Life. The Facts of Your Life booklet is excellent. It's an actual collection piece or data collection piece. It harvests client information and assets, and it has things on there that honestly I had never thought about before. It's absolutely free. It comes in book format, or we can attach email and send it to you. Either way, happy to send it to you. And you'll notice it has prospecting letters as well as prospecting postcards. What I like about this is a nice campaign, kind of a turnkey marketing campaign. If you're trying to look for first contact pieces to clients and customers, this could be an excellent piece. This has been approved by Allstate, but heads up, if you're a registered rep, you're going to have to go to your broker dealer and get your compliance department to say yes to these documents before you use it with the public, as well as if you're with an insurance agency that has compliance protocols, you're going to have to do that as well. Okay, well, let's just get into our last part. And of course, if you're looking at the kind of housekeeping that we do, we archive everything, whether it's the Edutrainment workshops or the Business Insurance Zone or Welcome to the Weekend with Steve Savant that I play on Saturday and Sunday. You go out to our site, we have everything out on our site on the on-demand video section, the big red button right on our homepage at www.brokersalliance.com. So you can always get caught up and stay on the edge of what we're doing. Now, before we get going, I want to talk a little bit about history and maybe we'll use the whiteboard here for a moment. I think what I'm looking for different ideas, is to try to convey what I think is easy to understand on the first pass. Now, actually, when we had insurance, the very first product we actually had was actually term. And when we needed to go into this phrase called permanent insurance, they came into this idea, permanent for life. Now, it's interesting, remember that different maturity dates or different endowment dates actually cause this phrase to be kind of strange. Let me give you an example. When I came into the business in the early 80s, I noticed a kind of a propensity for most carriers, and I'm just going to use a male as my example. Let's say my male is 45 and my maturity date or my endowment date was at 95. So what this meant was that I had to pay my whole life product or my premium, which was guaranteed. It's not an unbundled product like Universal Life. It's a packaged product, absolutely positively guaranteed with guaranteed cash values. And that product went from 45 back in the early 80s to age 95. That was the maturity date. Now think about this. If a client actually lived to 95, the actual contract would endow. So if he didn't have, for example, if he didn't die, there'd be that kind of cash. If there was $100,000 of death benefit, there'd be $100,000 of cash, or maybe even more, depending upon dividends. And the game would be over, and anything above basis would be a taxable event if you lived to that maturity date. That's why I bring up this issue that whole life has expanded itself. Most contracts now are heading out to 121. There's a few that use different riders that even go beyond that. But when we're talking about whole life, it's a time certain event, so keep that in mind. It has a kind of end game to it, and in my example here back in the 80s, when we were on the 1958 CSO, you can just see, wow, that was really a kind of a short 95. We're almost issuing policies at 95, actually at age 90 now. But I just wanted to kind of show you that basic idea, that basic example. Now, interesting enough, I cut my teeth on two products, level pay and graded pay, where you could pay the level premium payment, as I've described, all the way out to whatever the maturity date. Today, presently, it's about 121. Or you could have a graded or stepped up premium, which starts out lower and then gets higher as you get to the level pay. And before you know it, the step up rate then levels out. So you might want to be able to buy a level premium. Let's say levels we're going to use red for that. And that premium is going to be across here. So it is cheaper and earlier entry, and some of these graded premiums allowed us to use a term rider, which actually dropped the premium even lower in the stepped up or graded premium idea. Now, this is still out there, it's not as prolific as it used to be in the market. But I like to look at this because a lot of times you're looking at numbers like this and you're saying, gee, I need an entry level, and sometimes using a term rider on a level or a term rider on a graded can bring it way down if you're a proponent of whole life. Another thing I want to talk about as an idea, a base idea, is this issue of, we used to do what was called endowment contracts. Now, endowment contracts, I could take my 45-year-old again, my male 45, and the contract endowed at age 65. Well, in the old days, if that contract went to 65, then the client would say, I don't want to take constructive receipt of this, Steve. Can I go ahead and do a 1035 to these new products that are 95, age 100, 105, or as we're saying currently today, all the way out to age 121. But if we tried to do a 1035 or an exchange from that policy existing to our new policies, the IRS looks at this view and says this is not a like policy. So we can't 1035 a whole life contract that terminates at 65. And there is some discussion, by the way, and not clear, by the way, the service has not made a really good, clear interpretation of this. Whereas if I have differing dates, if I have different endowment date at 95, if I have different maturity date at 100, 105, when I exchange between 95 maturity date and 120 maturity date, is that a like contract? So there's some debate on that. Before moving forward, of course, with any of the things I'm talking about, always get the legal opinion from the two carriers, the existing carrier and the carrier you're going to make the exchange to, just to make sure that you want to be able to always make sure that you're doing what you're supposed to be doing and to really keep yourself on top of it. Now what I'm going to do is I'm going to go over to this doc that you can have, and anytime you want to write us on this, just remember, you can write for any of our stuff like our life manual and our vocabulary at thebiz@brokersalliance.com. That's thebiz, THEBIZ at brokersalliance.com. And the doc I'm going to show you right now, you can also order. It's a basic whole life description and definition, and you can order it again at thebiz@brokersalliance.com. Okay, so here's this doc I was talking about that you can again order at thebiz@brokersalliance.com. It's THEBIZ at brokersalliance.com. It's a basic description of whole life with a couple graphics here that just kind of give you an idea, a basic visual. Now, as you can see, whole life, and it's sometimes called permanent insurance, but again, that's a misnomer because we now have permanent insurance on 4 other UL chassis, and if you wanted to throw in the subset of second to die or survivorship, that as well is called permanent. But it used to be called also not only whole life, but it also had the nomenclature ordinary life. So ordinary life is designed to stay in force for a person's complete lifetime. It's not temporary insurance. If you remember back at our original courses when we talked the difference between term and perm, we said term insurance, term life insurance is for temporary liability, temporary exposure to economic loss. Permanent is I have a permanent problem. I have a permanent exposure, and that's why I need to buy permanent. Now, a lot of people believe that they will never ultimately have permanent insurance issues, but we've shown time and again that final expense is sold. Some of the biggest tickets that are written in life insurance are written in the geriatric ages that exceed age 60. So when I hear that, I often go, that you say that, and then when I run into it, I look at our total demographics, and I saw a study just about 2 months ago where the biggest growth in life insurance permanent sales is in the geriatric zone. So just be a heads up on that. Again, not to push a political issue here, but just to say there's a difference. But when we're talking about permanent, it's designed for the contract to stay in force for the entire life of the client. Now, unlike term, where premiums generally increase as the insured gets older, the portion of this premium actually stays level. And in this graph, it kind of shows you this. This graph down here, it says the red kind of look is the whole life, where it is more expensive than the term. And then the crossover year, it starts to become cheaper than the ART, or the annual renewable term showed on this example of ordinary life. Now, here's the death benefit. Notice we're sitting there looking at the death benefit idea here, and in blue, and I'm just trying to give you an idea of the time frame and looking at today's crossover. Now, the reason I can't give you a crossover, or kind of a general rule of thumb, is because male and female underwriting is going to be different, so the pricing is going to be different. And of course, the health categories are going to be different. It could be super preferred, preferred plus, preferred non-smoker, standard plus, or standard before we even get into rated cases. So it all matters. The crossover point, I basically go back to the idea is, if you're going to hold this for any amount of time, I generally say 15 years or longer. If you're going to buy a 15 or 20-year term, look at term for ROP, return to premium, or look at what the surrender value is projected at the guarantees versus the dividends, and get a little picture of what you think is going to be the best way to go. So this is just a basic graph. Again, if you want to order it, just order it at thebiz@brokersalliance.com. Now, we talked about this earlier today about limited pay, and there's two areas of limited pay in whole life land that I want to really bring up to your attention. In this example, we're showing the annual premium in red, which you'll notice stops at a certain period in time. In this case, it looks like it's about, not short of about 15 years. You can either buy limited pay whole life that is built to stop making payments at whatever year it is, 10 years certain, 15 years, 20 years to age 65, without the use of dividends. Now, it still has dividends, it just isn't predicated on limited pay or vanishing premium or paying a time certain based on dividends. There's also limited pays that are based on dividends, and you have to look at it. That's a risk because dividends are never guaranteed. And tomorrow we're going to get into basic uses of dividends, and we'll do a little introduction before the end of the show today. So when I'm looking at this doc basically shows it, and a lot of people use for common uses, again, when we talk about whole life use, family protection, business planning, accumulation needs, and charitable giving. If you're looking at a limited pay, you have a time certain event, and you look at the numbers between your actual exposure. If you need permanent insurance but you want a limited pay, this could be the way to go. Just remember, you have two choices, either one that's performing by dividends, which is not guaranteed, and one performed that's built into the contract to have a limited time certain event, so you have a limited payment and you don't have to worry about the dividends to make that happen. Now, the last point I want to bring up about whole life in this document, again, that you can have at thebiz@brokersalliance.com, just write me THEBIZ at brokersalliance.com, and we'll send it to you. Modified endowment contracts. After 6/21/88, there are certain rules of engagement on how much money I can put inside these contracts. Whole life is under the same subject, but has a little bit different rules. We'll get into that a little bit later. And when I'm looking at this, I'm looking at basic issues that I always want to make sure that we understand, additional policy elements. And this doc brings up the issue of policy loans. Policy loans, generally in whole life, are going to be spread loans, could be direct recognition loans. Some say that they are really wash loans. I have not seen, there might be out there, but I have not seen a zero net cost loan used in a whole life contract yet. But there's a few out there that are purporting wash loans and spread loans. And then there's only a few carriers that use what we call direct recognition loans, which in a way is not really that consumer friendly. It's great to protect the dividend payouts of the carrier, but I think it's a little punitive, especially if you're using it in income scenarios. So just a heads up. So when I'm looking at it, I'm looking for my policy dividends, which are not guaranteed and are a return of unused premium. You can use it to reduce current premiums, to buy additional coverage, to always have the ability to buy 1 year term, add it to your policy cash values for retirement. You can pay up the policy earlier than originally scheduled if the dividends are online, and it can be retained by the insured. You could even take it in cash. We're going to talk about all this tomorrow, about how are dividends produced and what can I use my dividends in a whole life policy.
This has been an Edutrainment Workshop, the educational division of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, and sponsored by Lincoln Benefit Life, an Allstate company.